We might flirt with interest rates around 7% if this war doesn't end soon. And the conversation in most real estate circles around this sounds like a five-alarm fire. Not just because rates being high, but also because there's a lot of demand. And sometimes we're seeing multiple offer situations, bidding wars. So between the prices and interest rates, it feels expensive out there. I want to slow this conversation down because history has something really important to say about what actually happens in quote unquote high rate markets. And it's probably not what you're thinking. What history actually shows us about high rate markets. Throughout the 1990s and early 2000s, mortgage rates settled into what was widely considered a normal range, and that was between 6 and 8%. Buyers moved forward without much hesitation because for homeowners who purchased during those years, 7% wasn't viewed as a setback. It was simply the market. Nationwide homeownership actually surged. It doesn't sound like a big jump, but it is when you take into account the population it's covering. The homeownership rate surged from 63.9% to 66.8% during the 1990s, a decade where mortgage rates spent most of their time right at 7%. People bought homes, people built wealth, the market kept moving. And the counterintuitive truth that I think gets lost in today's rate panic is that studies show that mortgage rates and home prices have a weak short term correlation of only 0.26%, meaning they sometimes rise together. A lagged effect does emerge over time. When rates rise quickly, home price growth slows within 1 to 2 years. Not home prices drop, home price growth slows. Extended periods of stable high rates have not necessarily produced falling home prices, which is the opposite of a lot of people's logic when they say that they're now going to wait for prices to come down. The median 30-year mortgage rate since Freddie Mac began measuring this and tracking it in 1971 has been 7.31%. Let that sit for a second. The rate buyers are currently panicking about is actually the historical average. The anomaly was not 7%, the anomaly was 2%. Now, I already know what you're thinking, sure, but homes weren't 400,000 to 500,000 in 1995. Fair point, for sure. In the early 1980s, when rates hit 18%, the median home price was under $70,000. That's a big difference. The math was different, and I'm not going to lie and pretend like it wasn't. But that objection about home prices being lower last time interest rates were higher misses something important. Wages were also dramatically lower. The percentage of household income required to carry a mortgage payment is really the more honest comparison of what's going on here compared to then. Not the sticker price in isolation and not leaving inflation out of the conversation. Uh, by measure, the most affordable payment in recent history backwards. The most unaffordable payment in recent history was October of 2023, when rates hit 7.9% on top of pandemic era price appreciation that had already run at 37% for the past 2 years. That combination, rapid price growth and appreciation, immediately followed by sharp rate increases, is what created an affordability crisis, not the 7% rates alone. Historically, high rates and high prices have rarely arrived together the way they did in 2022 and 2023. That double compression is what made those years genuinely brutal for everyone. What we're experiencing now is elevated rates on prices that have mostly stabilized. We are not coming out of a pandemic right now where prices jumped 37% year over year. What we are experiencing is uncomfortable, but it's a vastly different animal than what we saw before. Even with recent rates, many households are budgeting around a payment rather than a home price or an interest rate, which is actually how buyers approached this in the 90s. The payment first mentality is not new, it's just newly relevant again. Now, there's lesser discussed ripple effects of high interest rate markets, and of course, I want to talk about them. This is the part of the high rate conversation that rarely makes it into real estate content, but it should. The lock in effect freezes inventory. This is the golden handcuffs that we have talked about before. Research from FHFA found that mortgage lock in prevented 1.72 trillion transactions from 2022 to mid 2024 and increased home prices by 7%. The golden handcuffs increased home prices by 7%. High rates didn't lower prices, they raised them by keeping sellers who bought at 3% locked in a home that no longer fit their needs. By the time rates peaked in October of 2023 at 7.79%, the principal interest payment for the median priced home had jumped a ton, a ton. Not because prices exploded, but because the combination of higher prices, higher rates on higher prices compounded to a payment increase of 78%. Labor, mobility, shrinks. So when interest rates are higher, this is another one that most people in real estate circles don't talk about. People who can't afford to sell their home and buy a new one at current interest rates because they're higher stop moving for jobs. They turn down promotions in other cities. They stay in houses that are too small or too far from where they work. High mortgage rates don't just freeze a housing market, they freeze people in place professionally. A lot of times we don't talk about this either, but they stop people from growing families and taking other economic risks. The ripple effect throughout the economy extends way further than just real estate. Rental demand surges, but so do rents in accordance. As home prices remained high and rates climbed in 2022 and 2023, renting became a more favorable, financially attractive alternative, driving increased demand for rental units. And who benefits? Landlords. First-time homebuyers who can't qualify or could qualify but can't stomach the higher payment get pushed into a rental market that's simultaneously getting more expensive. It's a compounding trap where nobody wins, except landlords. Wealth concentration accelerates. High-rate environments favor cash buyers, institutional investors, and existing homeowners with equity, so the gap widens. The people most harmed are the ones trying to break in for the first time, which is exactly why the housing bill we covered last week matters as much as it does, and exactly why I am yelling so loudly about no buyer left behind in 2026, because it might be your last best entry point into the housing market. Then there's geographic migration shifts, because high rate environments historically have accelerated migration out of big cities, out of expensive areas, to lower cost effective living markets where the same rate produces a better lifestyle. The same price point gets you more house. We saw this play out dramatically from 2022 to 2024. Sunbelt markets, the California exodus, secondary cities, lower priced metros absorbed buyers priced out of coastal markets. Reno benefited a ton from this, and it would behoove us all to think about what that might mean right now. Even more, that isn't really being discussed, all of that history assumes that buyers who cannot buy have just been priced out. But right now, there is a meaningful group of people in this market who absolutely have the financial resources to buy a home and are being told no by a system that wasn't built to understand how they make money. I'm calling this demographic of people the modern earner. And not because their financial situation is all that complicated, but because the system hasn't caught up to how people are making money nowadays. The new rich don't always look rich on paper, but they exist in every market and at every single price point. And right now, they're one of the most underserved buyers in real estate. So let me paint you a few pictures. There's the VC-funded tech founder. She raised her Series A last year. Her company's valued at $12 million. She just started taking a real salary for the first time in 3 years. Before that, she paid herself $4,000 a month and pretty much reinvested every penny back into the company. So her personal tax returns show nothing. She's at poverty level based on those. Now, this year, she just started paying herself $800,000 in an annual salary. Her bank balance looks great. She's ready because she just went through Series B in her venture capital funding rounds. A conventional lender looks at her 2-year tax return and tells her she doesn't qualify for a mortgage. Weird. There's the business owner who has a solid write-off strategy, who understands the US tax code. He runs a successful construction company, for example. Gross revenue last year was $4.2 million. His accountant, doing exactly what a good accountant does, ran a $1.8 million in legitimate business expenses through the tax returns. On paper, his AGI is only $190,000. His actual cash flow, the money that hits his personal accounts, is well over $500,000 a year. A conventional lender calculates his DTI on $190,000 and tells him he can't afford the kind of house he's been building. for other people for the past 15 years. What about the real estate investor who has a portfolio of 11 properties now? She's generating $18,000 a month in rental income. She's never missed a payment. Never. Her properties are appreciating, but Fannie Mae's conventional guidelines cap a mortgage limit at 10 properties. You can't have more than 10 financed properties. She's got 11. She calls a lender, she gets told the limit, and walks away thinking, that's the end. I can't compound any more wealth this way. Nobody told her that there's DSCR loans specifically for her scenario. And when the property can just cover itself in terms of expenses, we don't have to consider her personal income and the number of mortgages she has at all. These are not edge cases, my friends. These are clients I meet and talk to on a daily and weekly basis. It might be you, or it might be your clients, it might be your clients' referral partners, or the person at your open house next weekend who could write a check immediately for a $25,000 earnest money deposit on a luxury home, but has been turned down by 3 lenders who don't know how to read their file. So, this is exactly why I'm focusing my podcast next week on the modern earner. Here's what we're going to cover: bank statement loans, DSCR loans, and most importantly, Fannie Mae, Freddie Mac, and FHA guidelines, because this is the part that surprises people the most. A significant portion of modern earners are actually being wrongly disqualified from conventional financing by loan officers who don't know the guidelines well enough to find a path towards closing. The founder who just started drawing a real salary, there's actually a Fannie Mae guideline for recent income increases that most lenders don't know about. The business owner with write-offs, there's actually a calculation method for self-employed borrowers that adds back specific expenses before we get into qualifying income. The investor with 11 properties, there's an exception process that could be used there. The problem is not always interest rates and affordability, guys. Sometimes the biggest hurdle standing between a hopeful buyer and their new home is a lack of experience or creativity from their lender. So I hope I'll see you on Property Pursuits next week so we can dive into all of this.